It is April 13th, 2026, and if you're watching the tape today, you are seeing like one of the most unbelievable contradictions playing out in real time.
Oh, absolutely. It's wild.
Right. We are talking about CoreWeave. Ticker symbol is CRWV. And on one side of the screen, this stock is just surging.
Yeah, it's up, what, over 9% today?
Yeah, exactly. Over 9%, driven by this mammoth $21 billion AI deal with Meta. Wall Street analysts are hiking their price targets, and, options traders are just betting the farm on this rocket ship.
The momentum in the order book is staggering right now.
It is. But then, you peel back just one layer, right? You look behind the scenes.
Then it gets messy.
Very messy. The CEO and the CFO have quietly unloaded over $600 million of their own stock in just 3 months.
Which is a massive red flag.
Right. So the question we have to ask you directly today is, are you looking at the AI opportunity of the decade here, or are you stepping right into a classic retail value trap?
That is the CoreWeave paradox, honestly.
It really is. And that's exactly what we're tearing down in today's deep dive. We are stripping away the hype to look at the raw financials, the technical breakouts, and, of course, the massive risks.
And just a quick disclaimer before we get into the weeds, this is just a natural debate exploring the data.
Exactly. Absolutely no financial advice here.
Right.
And hey, before we dig in, make sure to like the video and subscribe to the YouTube channel. Leaving comment feedback is compulsory if you want to keep these deep dives coming.
We want to know how you guys are playing this.
We do. So let's start with the headline hero stuff. Before we dig into the skeletons in the closet, why is everyone mashing the buy button today?
Well, the catalysts are huge.
They are. The stock is currently trading at $111.54, so up 9.35% today.
And the 52-week range on this is just incredibly wide.
Oh, it's violent. $33.52 all the way up to $187.
Which tells you how much volatility is baked in here. But the news today, that $21 billion AI cloud deal with Meta, it changes things.
And there's also the multi-year capacity lease with Anthropic.
Yes. And analysts are just eating this up. D.A. Davidson hiked their price target from $125 up to $175.
Wow.
Yeah. Citigroup sits at $135, and Bank of America is at $100. They see this as a massive validation.
So I kind of view this Meta and Anthropic news like, imagine you build a massive new mega mall, right? And you just landed the two biggest, most lucrative anchor tenants possible. It validates the whole build. But I want to push back on this a little bit.
Sure.
Because the sources note that Microsoft previously made up 71% of CoreWeave's revenue. 71.
That is a massive concentration risk.
Right. So is this explosive growth today, or are they literally just swapping one giant boss for another?
Well, I mean, it's a crucial diversification play.
You think so?
Definitely. Breaking that reliance on a single mega cap tech giant like Microsoft. That is exactly why Wall Street is rewarding them today with a moderate buy consensus.
Okay, that makes sense. You don't want all your eggs in the Microsoft basket.
Exactly. If Microsoft decides to pivot, CoreWeave would be in huge trouble. So Meta and Anthropic spread that risk out.
Right. Okay. But anchor tenants are great, sure. The problem is, how much did it actually cost to build the infrastructure to house them?
Now we're getting to the fun part. The balance sheet.
The grueling reality of the balance sheet. Let's look under the hood here because the 2025 income statement is fascinating.
It really is a tale of two companies.
It is. So on the top line, you have hypergrowth. Revenue was $5.13 billion. That's up 168% year over year.
Which makes them the fastest cloud provider to ever hit $5 billion, by the way.
Right. Historic pace.
Yeah.
And the EBITDA is an impressive $2.44 billion. That's a 47.5% margin.
Which sounds flawless.
It sounds like a money printing machine until you look at the actual bottom line.
Yeah, the brutal reality.
Net income is negative $1.17 billion. EPS is negative $2.81. And the free cash flow.
It's bad.
It's bleeding out at negative $7.25 billion.
And that's all before we even talk about the debt.
Oh, man, the debt. Total debt is this towering $29.82 billion against just $3.98 billion in cash.
It's a massive capital intensity issue.
And the spending is just accelerating, right? CapEx was $10.31 billion in 2025, but they are projecting it to skyrocket to between $30 and $35 billion in 2026.
That's the cost of the AI arms race. The pick and shovel play is not cheap.
But wait, if you calculate that burn rate based on the free cash flow, they are basically spending $2.60 for every single dollar they earn.
Yep.
I mean, if you had a friend who was spending $260 for every $100 they made, you would cut up their credit cards.
Right, you'd stage an intervention.
Exactly. So how is a nearly $30 billion debt pile sustainable?
Well, you have to contextualize why it's happening. The discrepancy between that great EBITDA and the terrible net income is driven by depreciation.
Because of the physical GPUs.
Right. They're buying tens of thousands of premium NVIDIA chips, and the accounting rules make them depreciate that hardware incredibly fast.
Because it becomes obsolete so quickly?
Exactly. But it also highlights extreme financial fragility. The sources give them a 2 out of 10 financial strength rating.
2 out of 10? That is practically zero room for error.
None. They have zero room for a misstep with those interest payments looming.
Okay, so with the fundamentals looking like, a high wire act over a pit of debt, how is the market actually trading this volatility today?
The tape is telling a very different story from the balance sheet.
It really is. Technical sentiment has completely shifted to a strong buy following today's gap up.
The momentum is undeniable.
Yeah, it's trading well above the 20-day simple moving average, which is at $89.82. And it's above the 50-day, which is at $85.69.
But the real immediate hurdle is happening right now.
Testing that major 200-day resistance line.
Right, at $103.02. That is the critical line in the sand.
If it breaks that, what are we looking at?
Well, holding that 200-day SMA is essential for short-term strength. If it holds, we're in breakout territory.
And the key support below that is the $101 breakout floor. But man, if it falls through there, the major psychological floor is way down at $64.88.
That's a long drop.
It is. Upward, though, the resistance ceilings sit at $114.50 and $124.
And the volume today is just explosive.
It's crazy. 32.4 million shares today versus an average of just 27 million. But the indicators are flashing some warnings, right?
Yeah, they are running hot.
Yeah. MACD is at 5.2, flashing a strong buy. But the RSI is at 69.8. It's rapidly approaching overbought.
And if you look at the order flow, the options traders are heavy on calls.
Yeah, 62% calls, right?
Exactly. Massive interest at the $130 and $150 strike prices.
Which means options traders are betting on a literal rocket ship.
Yep.
But with the RSI practically at 70, aren't we just driving a sports car straight into a brick wall of overbought exhaustion?
Well, you have to differentiate between momentum and exhaustion here.
How so?
A gap up on 32 million volume shows real institutional conviction. It's not just retail traders messing around. But again, holding that $103.02 level is everything.
Right. Okay, so the chart looks bullish. The momentum is undeniably real. But that forces us to bring up the most glaring red flag in all the source material.
The insiders.
The insiders. If things are so great and the chart's breaking out, why on earth are the insiders cashing out?
That is the ultimate debate here. Undervalued AI king or retail value trap.
I mean, CEO Michael Intrater and CFO Nitin Agrawal have dumped over $600 million in shares.
In just the last 3 months.
In 3 months, with major sales happening as recently as April 8th, 2026, literally days before this big Meta deal surge.
The timing is very noteworthy.
I'll use a stark analogy here. If I'm on a cruise ship and I look over and see the captain and the first mate quietly putting on life jacket,
You're not getting on the boat.
I am not buying a ticket for the next voyage. Why isn't a $600 million insider sell-off just a giant warning siren that retail traders are walking into a trap?
Look, it's a fair point.
Yeah.
Executives sell for many reasons, taxes, diversification. But yes, that timing is suspect.
Very suspect. And there's also the commodity trap risk.
Right, because GPU hardware becomes obsolete rapidly.
And you've got intense pricing competition from rivals, right? Like Lambda Labs.
Exactly. Lambda Labs and others threaten their margins. If compute power just becomes a race to the bottom on price, CoreWeave's margins get squeezed hard.
And the valuation is already a massive debate. They have a price-to-sales ratio of 9.07.
Which is highly overvalued compared to practically any peer.
It is. But then there's the counterweight. The one thing that makes this so confusing.
The backlog.
The monumental $66.8 billion revenue backlog.
It changes the entire conversation.
It does, because that provides visibility and guaranteed income all the way through 2032.
Right. It makes the value trap debate incredibly complex.
Because even if the present valuation looks stretched and they're bleeding cash, that future revenue is literally locked in.
It's an undeniable moat. You can't just ignore $66 billion in contracts.
No, you can't. Okay, so we've laid out this insane dichotomy. You've got a $66 billion safety net on one side.
And a $29 billion anvil of debt on the other.
Exactly.
Yeah.
So let's synthesize this for the listener. What are the actual best and worst case scenarios here? Let's start with the bull case.
Okay, the best case recovery. The bull case is that the $66.8 billion backlog guarantees their survival, period.
Right.
Plus, they have early access to NVIDIA's new Rubin platform.
Which is huge.
It is. It gives them the ultimate hardware advantage, and it helps them maintain that strong institutional backing.
So they essentially outrun the debt and solidify their spot as the premier AI infrastructure play.
Exactly.
Okay, but what about the bear case, the worst case continuation lower?
The bear case is that the $2.60 burn rate, combined with massive debt interest, just eats them alive.
Because the hardware obsolescence outpaces their massive capex.
Right. They buy chips, the chips get old too fast, and they have to spend another $30 billion just to catch up.
And the market eventually punishes non-profitable firms.
Heavily. In that scenario, retail traders are left holding the bag after the insiders have already exited.
With their $600 million.
Exactly.
So synthesizing all of this, what is the real outlook? Short-term versus long-term?
So short-term, the perspective is honestly neutral to bullish.
Even with the debt?
Yes, but only if it consolidates and holds above that 103.3 level after this roughly 25% weekly run.
And long-term?
Long-term is a different story.
Right.
The company's survival entirely depends on navigating that crushing debt burden.
They have to reach actual profitability.
By 2028, if they can't do that, the debt becomes unmanageable.
Wow. Okay, to quickly recap this intense dichotomy we've covered today.
It's a lot to take in.
It really is. You have historic hypergrowth, massive new $21 billion meta deals, and strong technical breakouts on the chart. But that is going head-to-head with terrifying debt levels, a fundamentally broken free cash flow model, and executive stock dumping.
Which leaves us with a final, highly provocative thought that the charts just don't answer.
What is that?
If CoreWeave has to spend $30 to $35 billion in CapEx next year just to stay relevant,
Yeah.
and they are already $29 billion in debt, who exactly is going to foot the bill when the music stops?
Oh, man. That is the multi-billion-dollar question, and we want to know what you guys think about it.
Let us know.
Drop your own bull or bear case in the comments below. Are you buying the breakout or avoiding the trap? Make sure you hit that like button and subscribe to the YouTube channel so you catch the next deep dive. See you next time.